Friends, you're most welcome again. We are in this session and we want to do more revision in respect to advanced financial management. Remember, this is a paper that is done in section 5, that is part 3, section 5, advanced financial management. We have been looking at May 2015 revision, and we have, in the previous sessions, we have looked at question 1, we have looked at question 2. Now, today, we want to look at question 3. In this session today, friends, we'll want to look at question 3. Now, question 3A, in the context, so what we are saying is May 2015, we are talking about advanced financial management. Question 3A, in the context of financial management in the public sector, explain 4 objectives of performance contracts in public sector entities. That is A. B. Explain the difference between open-ended funds and closed-ended funds. C. A share is currently selling at 120 shillings. There are 2 possible prices of the share after 1 year, 132 shillings or 105. Assume that the risk-free rate of return is 90%. Required the value of a 1-year euro call option with an exercise price of 125 shillings. Now, question 3A is saying we look at the objectives of performance contracts in public sector entities. Now, you need to remember that one of the items that you are required to have here is 1, to reduce or eliminate reliance on exchequer funding for government agencies which are expected to generate revenue or make profit. 2, to make an objective basis for divesting loss-making government agencies and also compel these agencies to give a return to the shareholders by paying dividends. 3, to ensure that public entities improve service delivery to the public. 4, to reverse the decline in efficiency and ensure that resources are focused on attainment of key national policy priorities of the government. Next, to institutionalize a performance-oriented culture in the public service through the introduction of an objective performance appraisal system. To measure and evaluate performance, to link reward to measurable performance, and finally, to instill accountability for results at the highest level in government. Now, we look at part B. Part B, they were saying, explain the difference between open-ended funds and closed-ended funds. Now, friends, when we say open-ended funds, they have no predetermined amount of stocks outstanding and they can buy back or issue new shares at any point. The price of the share is not determined by demand, but by an estimate of the current market value of the fund's net assets per share. Net asset value, that is, and a commission. While the closed-end funds are publicly traded investment companies that have issued a specified number of shares and can only issue a specified number of shares and can only issue additional shares through a new public issue. Pricing of closed-end funds is different from the pricing of open-end funds. The market price can differ from the net asset value. So you have seen, friends, one of the items is that you can, if it's an open-ended, you can buy shares at any point in time. But if it's a closed-end funds, you can only buy shares or can issue shares at a specific period and maybe at a public or as a public offer, not so frequently. A specified amount of shares will be issued at a specified period of time. Those are some of the main differences that we have already seen. Now, that marks the end of this question 3, and we are moving on to now the next question, that is question 4. Friends, thank you once again for tuning in. I'm your host, none other than Spotter Fred. We want to go through the revision of advanced financial management as we have been doing in the previous sessions. We are working on this part 3, advanced financial management, a paper that was done in May 2015. That paper, this is a paper that was done on 28th. It was on a Thursday, 28th May 2015. We have, from the previous sessions, we have looked at question 1, 2, and 3. Now, this session, we are looking at question 4. Now, in question 4A, we have been told to explain the following methods of company restructuring and state the circumstances under which each is appropriate. That's 1, sell-offs, carve-outs, and spin-offs. We'll look at part B later. So let's answer part A. Now, this is what you are required to answer. Now, Roman 1, sell-offs. A sell-off, also known as a divestiture, is the outright sale of a company's subsidiary. It is done when a subsidiary does not fit into the parent company's core strategy, and the market may be undervaluing the combined business due to lack of synergy between the parent and the subsidiary. Sell-off can also be used to raise cash, which can be used to pay debts or enhance / expand existing business. 2, we have been told to explain the carve-outs. This is done by the parent firm making a subsidiary public through an initial public offering. A new publicly listed company is created, but the parent keeps the controlling stake. This is done by a company when one of its subsidiaries is growing faster and carrying a higher valuation than other businesses owned by the parent. Apart from generating cash, the issue also unlocks the value of the subsidiary unit, thus enhancing the parent's shareholders' value. Roman 3, the spin-offs. These occur when a subsidiary becomes an independent entity by parent company distributing its shares to its shareholders through a stock dividend. It's not likely to be used if the firm needs to finance growth since no cash is generated. Like carve-outs, spin-offs are usually about unlocking hidden shareholders' value for the parent company. It sharpens management focus. So that comes to the end of question 4A. We'll want to look at question 4B, friends. So we explain, or rather look at question 4B. Question 4B, Shuka Limited, a company that manufactures mobile communication gadgets, intends to acquire Panda Limited when is involved in developing communications and networking software. The following financial information is provided for the two companies, as you can see for yourself. The current share price for Shuka is 5.8, for Panda is 2.4 shillings. Number of issued shares in Shuka Limited is 210 million shares, while in Panda is 200 million shares. Equity beta in Shuka is 1.2, in Panda is 1.2 as well. Asset beta is 0.9 in Shuka and 1.2 in Panda. Free cash flow to the combined company will be 216 million shillings in current value terms, and this will increase by an annual growth rate of 5% for the next 4 years before reverting to an annual growth rate of 2.25% in perpetuity. The combined operations of the companies will result in cash savings of 20 million shillings per year for the next 4 years. The debt to equity ratio of the combined company will be 4.4:6 in the market value terms, and it's expected that the combined company's cost of debt will be 4.55%. Corporation tax of 30% applies to the company. The current risk-free rate is 2%, and the market risk premium is 7%. It can be assumed that the combined company's asset beta is the weighted average of the respective companies' asset betas required. Estimate the additional equity value created by combining the two companies based on the free cash flows. Those are 14 marks. So we are going to use the free cash flows as one of the evaluating techniques. We are going to use the free cash flows as one of the evaluating techniques in combining the two companies. That is important. So we are going to look at that for the 14 marks. Now, friends, now in this question, as we must have said, we are to estimate the additional equity value created. What will be the additional value that we are going to create if you use the free cash flows in the combining of this company? That means that we are talking about May 2015, question 4B, that's advanced financial management. In this, we are looking at the additional value, the additional value to be created. This, it means that we are going to get the value of equity after combination using free cash flows. Then we subtract the combined market value of equity. The combined market value of equity, this means that we take the current share price of 5.8 by 210. Then that's for Shuka. And for Panda, the same story. That's Panda is 2 shillings and 4 cents. Then we multiply by 200 million. That's the plan of attack. So it means that if you talk of the combined market value of equity, it simply means we take the market price per share of Shuka. Let me take 210 million shares of Shuka. You multiply by 5.8. Then you also add, that is for Panda, 2 shillings and 40 cents. You multiply by 200 million shares. That is our combined. So I take my calculator and get this 210 by 5.8, friends. It's coming to 1218. Then plus the 2.4 by 200, that is coming to 480. The total of which is coming to 1218. I add 480, that's 1698. That is the combined market value of equity for the two companies. So we want to get the value of equity after combination or using the free cash flows. The first thing, friends, we need to determine the free cash flows. We need to determine the free cash flows. What are these free cash flows? Let me go back to this information once again. We have been told that they intends to acquire, Shuka intends to acquire Panda. We have been told the current share price, that's okay. The number of shares issued, the equity beta, the asset beta, that's okay. Free cash flow to be combined to the combined company will be 216 million in the current value terms. And this will increase by an annual growth rate of 5% for the next 4 years, before reverting to an annual growth rate of 2.25% in perpetuity. So in the next 4 years, it will be 216, but will be increasing by 5%. And we have also been told that in the 5th year, or rather later, thereafter into perpetuity, it will grow by 2.25%. That's perfect. But there's also the next sentence saying that the combined operations of the company will result in a cash savings of 20 million per year for the next 4 years. So let's determine the free cash flows. We determine free cash flows. let me talk about year 1, year 2, year 3, and year 4. We talk about the free cash flows growing at 5%. You know, it is 216. The first year is 216 will grow. That's 1.05 by 216. That comes to 226. 226.8 million. Our figures are in millions, don't forget that. Then the next one will definitely be that 226 will increase by 5%. So 1.05 we get, no, that is 226.8 by 1.05. We are getting 238.14. The next one is 1.05. Then is coming to 250.05. The next one is 1.05. We are getting 262.55 to 2 decimal points, rounding off to 2 decimal points. That's what we have done. We have increased it by 5% every year in the 4 years. The combined operations of the companies will result in a cash savings. So there's a cash savings every year of 20 million. There will be 20 million. There will be 20 million. There will be 20 million. That's the saving. So what will be the total free cash flows? That will be 246.8. That the next one will be 258.14, 270.05, 282.55. So that's what we have. So we already determined our free cash flows. Now we need to discount because we need to get the value of the company. So it means we need to discount these free cash flows. We need to discount. So we need to get the present value of free cash flows. The present value of free cash flows. What are we going to do here, friends? The present value of free cash flows, we simply take the cash flows. We multiply the present value, interest factor R% n years. The issue is, what is 100%? What is it? How do we get the cost of capital? Remember, this, if we go further reading this statement, the third paragraph, the debt to equity ratio of the combined company will be 4:6 in the market value terms, and is expected that the combined company's cost of debt will be 4.55%. Corporation tax of 30% applies to the company. The current risk-free rate is 2%, and the market risk premium is 7%. It can be assumed that the combined company's asset beta is weighted average of the respective company's asset betas. Now, R is a risk-free rate, and is the cost of capital. But you realize that this not only has equity, but it also has debt. There is the debt. So we need to determine the weighted average cost of capital. That's now our overall cost of capital. Overall cost of capital. We need to determine the overall cost of capital. You know that our overall cost of capital, friends, is going to be the weight, which is the weight of equity, KE. The weight of equity is 60%. No? That is, we have been told, debt equity ratio. Yes. The weight of debt is 40%, while for equity is 60%. Then we add the weight of debt, KD. No? KD 1 minus T. That is very important to remember. Now the issue is, we have no problem with KD because we already have it. We have been given as 4.55%. That's when we have it. The issue is, how do we get the KE? The weights, we have them. We have said the weight for equity is 60%, for debt is 40%, KD is 4.455%, T is the tax rate. We have it as 30%. So what we don't have is a KE. KE, we can use CAPM. We use CAPM to determine the cost of capital for this equity. So CAPM, using CAPM, we take the risk-free rate plus the expected of the market minus the risk-free rate, then you bring in the beta for an levered firm. So we are going to calculate that. Remember, friends, we have been given the risk-free rate. We have been given the risk-free rate. The risk-free rate from the last paragraph is simply 2%. We have been given the expected return of the market minus risk-free rate. We have been given that as 7%. We have not been given the beta. We have not been given the beta. We have not been given the beta.